June 17th, 2026. I thought I'd update my wave trading process video with some more detailed information. So we'll cover in this video the 5-wave move, the ATR, pour structure, and options expiration support and resistance. So anything worth trading should have a 5-wave move 19 out of 20 days. So if you're not trading something that doesn't have a 5-wave move 19 out of 20 days, you're probably going to struggle. So you want something that's a very consistent performer in terms of the number of waves made per day. I'll give you one caveat. The 5-wave move doesn't have to be the largest move in the day. So for instance, if you're trading something like AVGO, and if it drops 20 points in the first 15 minutes of the day, but it only puts in a 1, 2, or 3-wave move, the 5-wave move that follows will most likely just trade inside of that and retrace part of that 20-point move that's been made. So don't assume that the 5-wave move has to be the largest move throughout the day. That's why it's extremely important to know the ATR. So the ATR is your average trading range. You could also change that acronym to average daily range. So you're going to need to look back X number of days. You define X and know what that average trading or average daily range. So that would be the price that the stock or future typically moves throughout the day, every single day, 19 out of 20 days. So in this case, let's just for fun today, let's just say that AVGO, which is what we're looking at, Broadcom here, moves roughly about 15 points a day recently. Okay, so now I'll get into the 5-wave move. I'm going to zoom in and get into the 5-wave move. But first, we also need to understand what constitutes a wave. So I'm going to go ahead and zoom in on that. So I created this legend for this video. I've got a couple acronyms. CUC is candle. Whoops, I gotta update that. Okay. So CUC is candle under candle, and COC is candle over candle. So the waves will be made up of structure that looks like that, and that's also how the waves begin and end. They end with CUCs and COCs. Must always evaluate the bodies, not the tails and the wicks. So don't evaluate the tails and don't evaluate the wicks. It's always the bodies. And if you're trading stocks, beware of stocks that trade sub-penny. Most stocks, even AVGO, which is almost a $400 stock right now, trades in the sub-penny increments. If you don't have a script that captures, or you're going to need a script that captures the open and close of every candle to capture those sub-penny increments. Because oftentimes these platforms, they will just round up on the actual chart itself. They will round up or round down, and you won't actually see the sub-penny increment that the stock actually traded at. That's why trading futures is much cleaner, because there is no sub-penny increments. Okay, so the black section here is the current market today, the U.S. regular session hours, and then the gray section is the pre-market. So I'm going to start here on, I'm going to zoom in a little bit more. I'll move Whoops. Okay. So let me zoom into this section. Let me bring that back down. Okay, so here you see AVGO market, first 1 minute candle here, and price starts moving down. Then on this blue candle, what you see here is, if you really zoom in on your chart, or if you look at mine, I might be zoomed in enough, you can actually see the gap. But typically we're not zoomed in that close, so it's difficult to see those gaps. That's why I have a script. So this green wedge tells me that this candle body here opened above where this candle body closed. So that constitutes a gap. So how do we know when price is no longer going down? Well, as soon as you have a condition where it's candle over candle, so a COC, so this is candle body, and this candle body is over this candle body. So that's candle body over candle body. So now we know price is no longer going down, it's going up. So if you were shorting AVGO this morning, well, now you know price is no longer going down and it's going up. How do we know when price is no longer going up? Well, we have to wait for the candle under candle condition. So here price just goes up, 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 and then here on this candle, right, this gray candle here, I have this gold colored wedge. This tells me that there's a gap between these two candles, between the two bodies. So now I know that as soon as I have candle under candle condition, price is no longer going up. So that's how you determine when price stops trending up and when price stops trending down, and we'll follow this all the way down. So we can see that AVGO crossed the morning opening print. It went up, made a wave high, it pulled back, pulled back, pulled back. And then here we have this is our lowest bodied candle. So I find the smallest and lowest body candles either at the tops or the bottoms for the wave, the new wave reversal, the starting point or the beginning. So here, this candle body, it intersects this candle body. So this is not candle body over candle body, but 2 minutes later, this candle body is over this candle body. So now we know that price is no longer going down, it's now going up. So back to the 5-wave move. We expect a 5-wave move in whatever we're trading. So I'm going to scroll a little bit to the right now. So this would be, I'll just document these for this video. It's going to be a long video. So this is our wave 1 beginning, our start. And this is our wave 1 end. On this candle right here, we know that price is no longer going down. We know that price is going up. So this candle is wave 2, start. And then we just follow the trend up until we find the condition. And wave 2 must be that the candle body must print above. So the open and close of the wave 2 high candle body must be above wave 1. So you can see that this candle here, it's intersecting the wave 1, this red candle, which is the wave 1, it's intersecting. So that's not the top of wave 2 because it doesn't meet the condition. It's not completely above the previous wave candle body. Here, this candle is completely above. It opens here and closes here. So now we know that, okay, wave 2 is happening, which is good. This is what we expect, price to go higher. But then price stalls and reverses. So at this point, once we get this condition, candle body, this candle body is now underneath this candle body, we know that this is wave 2 end. And that price is coming down. And in the perfect world, price will not break the previous wave low. And this is where I do use tails. So we would expect that wave 2 would pull back, but not break where the wave 2 started. So wave 2 is pulling back, and then we get this candle, which is intersecting, so this is not a reversal yet, and then we get this large candle here, but you can see that that candle here body is intersecting this one. So this is not technically yet, by my definition, a wave 3. But we can see on this candle that this candle body is clearly above this lowest candle body here. So therefore we know price is no longer going down. We expect price to continue. So let's document where wave 3 begins. That's this green body. Wave 3 start. Scroll to the right. So wave 3 must print candle bodies above the wave 2 high candle body. So that close on this candle is 393.33. So as I look to the right, I'm looking for a candle body that might be above that. Let's look at this blue doji. It opens at 393.4 and it closes down at 393.29. So this is 393.33 close. This close is 393.29. So those candles are intersecting by 4 cents. That is not the wave 3 high, because it's not a candle body printing clearly above wave 2. So we're going to keep going right. So here we can clearly see that where this candle body is now, it's intersecting the wave 2 candle body, but it does close above, so that's good. We need to see the trend continue, and now you see this candle body printing above the wave 2, same with this one, and then same with this one. So our wave 3, when we look down at this candle, we know that price is no longer going up, so this is our wave 3 high, and this candle body is underneath this candle body. So this is wave 3 end. And then, like I said, this candle body is underneath this candle body, even just by a penny or two. Let's confirm that. Because maybe I'm wrong. So that opens at 393.82. This one opens at 393.79. So that is below. So that is the wave 3 end. We get the pullback. This would scroll right. So this candle body here is wave 3 transitioning into a wave 4. This candle body is now clearly above this candle body, so this is where we know wave 4 begins, or wave 4 start. Now as wave 4 progresses, we need to see prices closing above the wave 3 candle body. So we see the close above, but once again, this is not the top, because it cannot be the wave 3 end, because the candle body intersects the wave 3 candle body. They overlap by some, maybe 15-20 cents in here, maybe more. And then price goes up, and this candle body is clearly above wave 3, so everything's looking good. And then this next candle, and then here we know that wave 4 ends because this candle body is under this candle body, And my graphically, this orange down wedge tells me immediately that there's a gap between those two candles. So this is wave 4 end. Now we're looking for a pullback. Down, 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 down. We prefer that the pullback not go below the wave 4. However, in this case, you can see that the wave 4 does, as wave 4 transitions into the wave 5, it does pull back, it does dip below, but it never closes below that wave 4 low candle body. It comes close to closing and opening below here, but it is still above, which is what we want to see. So how do we know no price is no longer going down? Because we see this candle body right here. Let me zoom in. This candle body is above this candle body, and it's very hard to see, but my green wedge tells me that this candle body is opening above this candle body. So I know at this point that this is the wave 5 beginning, wave 5 start. Now the wave 5 end doesn't always need to be a body above the wave 4. It can just be a wick. So you have to be very cognizant of that, very aware. So we'll just scroll right and see, we'll zoom out. So here we can see that wave 5 is beginning, push, 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 and all we're really looking for is maybe some wicks above. But in this particular case, we get the close above on this candle, but yet it's intersecting this one. So it could be the end. We really don't know. But here, price does push a little bit higher, and then when we finally get this candle body under this candle body, we know that that is the wave 5 end. So let's zoom out. Let me just switch tickers real quick to reset the scaling. Okay. So there's all of our waves, wave 1, 2, 3, 4, and 5. How do you know that potentially that you're getting that wave 5 isn't going to push much? Because with our ATR, average trading range, or our ADR, average daily range, as defined by you, which is X number of days that you're looking back, and if we can say, okay, AVGO in the last 8 to 10 days is trading at a $15 range every single day. So if I just kind of estimate this down here, we'll just call it 383, and I go up, this wave 4 actually went above 398. So that is from 83 up to 98. That's a $16 move. So I've already exceeded that $15 average trading or average daily range. But I am looking for that wave 5 move that we consistently know we should get. And so therefore, if I had been trading this long still today, I would not be expecting much. And I would be taking profit as soon as price started pushing over the wave 4 body, not even the wick, just the body itself. I would take profit. So let's talk about poor structure. So how I define poor structure is, let me move this over here. Whoops. Sorry for moving around so much. So what is poor structure? So for me, poor structure is where you cannot connect 4 candle bodies. So let's find that. So here on this first 1 minute candle, I can't connect 4 candle bodies. Really, I mean, my last connection point would be back here. Also overlaps with that, and there's a gap between these two. And price dips down and comes back up. But at this point, the price just basically just rips through this first 1 minute candle. So if I'm just even evaluating just the 1 minute candle, I can only connect this body and this body right here, all the way up through to the bottom of this, to the bottom of this one. So many people would call this a fair value gap. So it is possible. You have to be very extremely cognizant of these, that price will retrace all the way back down into that poor structure area. It will be a target to hit at some point in the future. So today is a Thursday, and options are expiring. Tomorrow is actually monthly options expire, but you could be trading some type of daily option or a weekly option. And so I suggest that you actually just also look at the options chain to know when the expiration date is on the next closest option, know where support and resistance is based upon the actual open interest. So I'm going to switch over to the options chain, and hopefully it will show up. So this is the options chain that expires today, but I actually want to look at we can look at today's. Tomorrow's of more interest to me. But here you can see at the 400 strike over on the call side, the open interest at 395, there's 1,094 contracts, and then at the 400 strike, there's 1,778. So you can see that there is a gap of 622 in between these two. So for today, I would actually expect probably AVGO to close inside of here. Then over on the put side, you can see that here's the open interest at the 395 strike. On the puts, there's 1,458, and you can basically kind of look at that as also potentially support for AVGO. So don't spend a lot of time on the options chains, but just kind of look for the holes in the open interest and or support and resistance values. And then put everything into context. You know your average trading range, your average daily range, and this will also help you understand, like, okay, is there still a significant move that potentially could happen today if you haven't hit the ATR or ADR. Switch back to the chart. Hopefully all of that was recorded on the video. If not, you can go look at the options chain on your own. Okay. So the last thing, which I didn't put on my agenda, but we'll add it here, would be entries and exits. And adding. So you don't need to nail the bottom, and you don't need to nail the wave 1 bottom, and you don't need to nail the wave 5 high top. If you're good at that, great, awesome for you. Most people aren't. So most people would probably just be content with capturing 2 to 3 of the waves inside of that move. So let's say that you were trading AVGO this morning and you saw this wave 1 up, and you don't want to chase all the way up here, and so you know that, hey, AVGO hasn't made its 15-point move today, and I'm going to look for a pullback, possibly down into this poor structure, and then you see that pullback happening here on after wave 1, and then you see this hammer candle and then another small body candle. This would be your chance to get in right here and put your stop immediately below this wick or this tail down here. So when I use my stops, I would use the tails or the wicks. You could also get in as on this candle like 1 second before this candle closes as well. Once again, your stop would be down here, and then you're staying in the trade, waiting for that 5-wave move to develop based upon the knowledge you have about the ATR or ADR for whatever it is you're trading, whether it's stock, futures, or crypto, it doesn't matter. Now, let's say you've taken a small position here, right, somewhere in here, and you want to add. Frankly, you can add anywhere you want. If you're trading the 5-wave process, your stop for your add should be at the wave 2 low, like 1 penny below it. If you want to be more precise, you can wait for wave 2 to develop, the pullback, and then wait for a bullish signal like this green candle, and then you could get long anywhere on this candle or the next candle. So that's how you could add to your position. I strongly recommend just putting in limit orders for your targets to be filled versus marketing out. You can mark it out on like the 5th wave move, but if you want to close your position anywhere between wave 1 and wave 5, I highly suggest just putting in your limit orders, and sell when price is actually going up, not when price is pulling back. So only on the wave 5 would you ever market it out, because if you believe in the 5-wave process, you consistently see it with what you're trading, it will make that 5-wave move, then you should always be selling into strength, not selling into weakness. That will help you maximize the profits in your trading. Let's talk about one other thing here is that, so wave 4 went up and then it pulled back and then it put in this low here and then it went candle body over candle body. So why am I not counting this as the wave 5 start? Well, if I was trading AVGO today, I would have. But what happens is, and we can just document this, so this would be a wave 5 start by my own definition, but we're going to color code this red. Why? Because it failed. It failed because price actually went lower. So this wave 5 start is a failure. Everything was looking good. As soon as this candle closed above this candle, so it's candle body over candle body, we're bullish. We're looking for that push up back into wave 4 and maybe just a little bit of a peak above wave 4, because we already know we've hit the ATR, ADR range for the stock that day. But then price fails and comes down, right? So this is our highest candle body here, and then we get this candle body here underneath this candle body. So now it's failing. It's failing. So right now it's just making, right now there's no worry. It's just making an internal wave between here and here. It's just making an internal wave. You can think about it of just consolidating inside of an existing wave pattern. No need to worry. Your stop at that point in time is 1 penny below this. So what ultimately happens? You get stopped out right here. Then, let's say you say, okay, well, it came down into this consolidation. It just came down by a few cents, stopped me out. This pushes candle body over candle body. So the green wedge tells us that this candle body, and you can probably see it, is above this one. So let's say you get long here on the close of this candle. Your stop is now here. And boom, you end up taking another stop several minutes later. Very frustrating. 100% agree. Nobody likes being stopped out and taking uh, losses, but that's part of the game. So if you're still bullish on AVGO making the 5-wave move or whatever it is you're trading, you get the second opportunity down here. And what you can really see this time is, yes, there was some small candles, small body candles down here. They're right in this consolidation range, making a connection of 1, 2, 3, 4, 5. There's at least four or five candle bodies connecting. 5 candle bodies connecting in this zone now. So that's a good thing. You see candle body over candle body. Boom, you're long again. Stop down here. And you're literally just looking for a push back up into this, even though AVGO pushed higher. You might hold close to 400 in this case on this day because you're expecting price to test those test that 400 strike on the options to force any naked call sellers out at 400 strike, or any naked 400 put sellers. So that covers my wave trading process in the most detail that I can provide. I hope this video is useful to anyone watching. Thanks. Have a great day.